Chapter 1. Why stock market enthusiasts should care about central banks. As stock market enthusiasts, you're always looking for an edge. You devour market data, analyze trends, and scrutinize company reports, all in pursuit of that winning investment. But have you ever considered the crucial role central banks play in shaping the financial landscape? Central banks like the Federal Reserve in the United States and the Reserve Bank of India are powerful institutions with a significant impact on your investments. They are the guardians of a nation's economy, tasked with maintaining price stability and promoting economic growth. Their decisions reverberate through the stock market, influencing everything from interest rates to corporate profits. Understanding how central banks operate and how their actions affect the stock market can provide you with invaluable insights. This knowledge can help you anticipate market movements, manage risk, and ultimately make more informed investment decisions. So, buckle up as we delve into the world of central banking and explore how their policies influence your investment journey. Chapter 2. Two sides of the same coin. Before we dive into the intricacies of central banking, let's first establish a common understanding of two critical concepts: inflation and deflation. These economic forces are constantly at play, shaping the value of your money and influencing the direction of the market. Inflation is simply a rise in the general price level of goods and services in an economy over a period of time. When prices go up, your purchasing power decreases, meaning you can buy less with the same amount of money. Imagine your favorite cup of coffee costing $2 one day and $2.50 the next. That's inflation at work. Deflation, on the other hand, is the opposite of inflation. It's a sustained decrease in the general price level of goods and services. While lower prices may sound appealing, deflation can be detrimental to economic growth. Think of it like this: if people expect prices to continue falling, they may postpone purchases, leading to reduced demand and economic stagnation. Central banks strive to maintain a delicate balance, keeping inflation in check while avoiding the perils of deflation. Their goal is to foster a stable economic environment where businesses can thrive and consumers can confidently spend and invest. Chapter 3. Interest rates and liquidity. Central banks employ a range of tools to manage inflation and deflation, with interest rates and liquidity management being the most potent weapons in their arsenal. Think of these tools as levers that central banks can adjust to influence the flow of money and credit within an economy. Interest rates are the rates at which banks lend money to each other and to their customers. By raising or lowering these rates, central banks can influence borrowing costs for individuals and businesses. Lower interest rates generally encourage borrowing and spending, stimulating economic activity. Conversely, higher interest rates tend to curb borrowing and spending, acting as a brake on inflation. Liquidity management refers to the central bank's control over the money supply in an economy. They can inject liquidity into the system by buying government bonds or other securities, effectively increasing the amount of money available for lending. Conversely, they can withdraw liquidity by selling securities, reducing the money supply. Increasing liquidity can boost economic activity but may also fuel inflation, while reducing liquidity can curb inflation but may also dampen economic growth. Mastering these tools is crucial for central banks to effectively manage their economies and maintain a stable financial system. Chapter 4. Steering the American economy. The Federal Reserve is the central banking system of the United States. Established in 1913, the Fed operates independently of the government, making decisions based on economic data and its mandate to promote maximum employment and stable prices. The Fed's primary tool for influencing the economy is the federal funds rate, which is the interest rate that banks charge each other for overnight loans. By adjusting this rate, the Fed can influence interest rates throughout the economy, impacting everything from mortgages to credit card debt. For instance, in response to the 2008 financial crisis, the Fed slashed interest rates to near zero and implemented quantitative easing, a policy involving large-scale purchases of government bonds and other assets. These actions injected liquidity into the financial system, stabilized markets, and helped prevent a deeper recession. The Fed's actions have a profound impact on the U.S. stock market. Lower interest rates tend to boost stock prices as borrowing costs decline, encouraging businesses to invest and grow. Conversely, higher interest rates can put downward pressure on stock prices as they increase borrowing costs and potentially slow economic growth. Chapter 5. Navigating India's Financial Landscape. The Reserve Bank of India, or RBI, is India's central bank and plays a pivotal role in managing the country's monetary policy and ensuring financial stability. Established in 1935, the RBI acts as the banker to the Indian government and regulates the country's banking system. The RBI's primary policy rates are the repo rate, the rate at which it lends money to commercial banks, and the reverse repo rate, the rate at which it borrows from banks. By adjusting these rates, the RBI influences borrowing costs and the money supply in the Indian economy. For example, in recent years the RBI has implemented a flexible inflation targeting framework, aiming to keep inflation within a specific range. To achieve this, the RBI has adjusted policy rates in response to inflationary pressures, aiming to maintain price stability while supporting economic growth. The RBI's actions have a significant impact on the Indian stock market. Rate cuts tend to be viewed positively by investors, as they can boost economic activity and corporate profits. Conversely, rate hikes can create uncertainty and potentially dampen investor sentiment. Chapter 6: How interest rate changes impact your investments. Now that we've explored the roles of the Fed and RBI, let's delve into how their interest rate decisions directly impact your investments in the stock market. Understanding these dynamics can help you anticipate market movements and make more informed investment decisions. When central banks like the Fed or RBI cut interest rates, it generally creates a favorable environment for stocks. Lower borrowing costs encourage businesses to invest in expansion, research and development, and other growth initiatives. This in turn can lead to higher profits, which tend to boost stock prices. Conversely, when central banks raise interest rates, it can create headwinds for the stock market. Higher borrowing costs can squeeze corporate profits, making it more expensive for companies to finance their operations and invest in growth. This can lead to lower earnings expectations and potentially dampen investor sentiment, putting downward pressure on stock prices. However, it's important to note that the relationship between interest rates and stock prices is complex and not always linear. Other factors such as economic growth, inflation expectations, and geopolitical events also play a significant role in shaping market sentiment and influencing stock prices. Chapter 7: Balancing Inflation and Economic Growth. Central banks face a delicate balancing act, promoting economic growth while keeping inflation in check. It's like walking a tightrope, requiring careful calibration and a constant assessment of economic conditions. When inflation runs too hot, central banks may raise interest rates to cool down the economy, potentially slowing economic growth. Conversely, when economic growth is sluggish, central banks may lower interest rates to stimulate borrowing and spending, even if it means tolerating a bit more inflation. Finding the right balance is crucial. If central banks raise rates too aggressively to combat inflation, they risk triggering a recession. On the other hand, if they keep rates too low for too long, they risk fueling excessive inflation, which can erode purchasing power and destabilize the economy. The challenge for central banks is to strike the right balance between supporting economic growth and maintaining price stability, a task that requires constant monitoring, analysis, and often difficult decisions. Chapter 8: Tips for Savvy Investors. As a stock market enthusiast, staying informed about central bank actions is crucial for making informed investment decisions. Here are a few tips to help you navigate the world of central bank watching. First, follow the economic calendar. Keep track of central bank meetings, speeches by key officials, and the release of economic data points, such as inflation reports and GDP growth figures. These events can provide valuable insights into the central bank's thinking and potential policy actions. Second, read central bank statements. Pay close attention to the language used in central bank statements following policy meetings. Look for clues about their outlook on the economy, inflation expectations, and potential future policy moves. Third, analyze market reactions. Observe how the stock market reacts to central bank announcements and speeches. Market movements can provide real-time insights into investor sentiment and expectations about future economic conditions. Lastly, consider a long-term perspective. Remember that central bank policies impact the economy and financial markets over the medium to long term. Avoid making impulsive investment decisions based solely on short-term market fluctuations. By staying informed about central bank actions and incorporating this knowledge into your investment analysis, you can gain a valuable edge in the market. Final Chapter 9: Knowledge is Power in the World of Investing. The world of central banking may seem complex and esoteric at first glance, but understanding its intricacies is essential for any serious stock market enthusiast. Central banks wield enormous influence over the economy and financial markets, and their decisions have a profound impact on your investments. By grasping the fundamentals of inflation and deflation, the tools central banks use to manage these forces, and the ways in which their actions influence the stock market, you can become a more informed and confident investor. Remember, knowledge is power. The more you understand about the forces shaping the financial landscape, the better equipped you'll be to navigate market volatility, manage risk, and achieve your investment goals. So stay curious, stay informed, and never stop learning.